Good morning. My name is Seth, your Metro Detroit real estate expert. And with me, as always, your nationwide mortgage expert, Steve Frost. Good morning, Steve.
What's up, Seth?
Not too much, not too much. I'm going to hit on some points as always today. I'm going to talk a little about Metro Detroit and nationwide data because I feel like I bounce back and forth between the two and never sit here and compare them. Because compared to what's going on nationwide as an average, here in Metro Detroit, things are drastically different. So new listings right now in Metro Detroit are actually down 1.3% year over year. And on a nationwide basis, we're up 6.1%. And a lot of this has to deal with a couple of major markets that are some heavy hitters and softening markets. And I think it's like Austin, Texas, Dallas, Texas. I think Miami is putting a big dent on these averages. So it's not really showing the true colors of what's going on here in Metro Detroit. And I want to make sure that my audience that watch this is from Michigan, so I want to make sure that we get hit on the right points. So, like I said, new listings here in Metro Detroit down 1.3%. So we have less inventory than we did last year. Pending deals here in Metro Detroit up 6.1% year over year. So we actually have more pending deals going on, while nationwide is down 5.7. So here in Metro Detroit, we're doing better, almost double better than everybody else, if I said that right. And then
Double better.
inventory, double better. We're gonna make that
That's
in the
good.
dictionary of Seth. Inventory nationwide is currently at 3.6 months of inventory, and here in Metro Detroit, we're at 1.4. So we're still at historic lows at inventory. So as you see here in Metro Detroit, there's still things that are hitting the market and flying off the shelf, right in that 250 to 350 range. And I think that's a big factor in why we haven't been hit as hard as here in Metro Detroit. Our price point is more of a lower barrier to entry than many of the other price points that are getting considered, such as Dallas, California, Miami, all those big cities. I mean, an entry level house can be five, $600,000. Where here, if you're looking south of Detroit, you can get a nice starter house for 175, $200,000. And I think that's making a big impact on why we've been able to stay strong in the market that's starting to soften a bit. And I do want to touch on why the market could be softening is we are in an election year. So anytime an election year goes on, typically data gets a little bit offset because people hesitate to make moves because they don't know what's going to happen in the future. And people are just at a mass scared, especially right now with everything that's going on. I'm not going to talk too much about that, but it is causing things to slow down a bit. Would you agree, Steve?
It's a circus.
It's an absolute circus. So
The
that's why
one
I've
the
been
one
hitting
thing
on.
that's consistent with every election cycle is that they're all always a circus. It's just a matter of what the circus looks like and when it happens, you know?
Yes. So I'm going to continue to touch more and lean more towards the Metro Detroit data moving forward, just because I want to make sure that the people that I serve are keep kept up to date at a high level on what's going on here rather than nationwide, since the data is so drastically different. How are we doing on rate, Steve?
So rates are still holding steady, in that mid to high sixes, depending on how we get things structured for you. So that's like your 30-year rates. I'm doing some 15-year loans, and we're using a little bit of strategy and things like that. We're looking at some rates below six. All of your government programs. So we have some really cool. If anybody's watching this and you have an FHA loan or a VA loan, you should definitely give us a call or reach out. There's really, really cool pricing incentives. And in an FHA loan or a VA loan, you have an opportunity for what's called a streamline with no income verification, no appraisal, and really, really great way to save some money. But even being said, our government products you're seeing down in the low sixes. So rates have had a really nice move, and we've been basically staying in the same channel since CPI came out about 2 weeks ago, because we haven't had any real big data or big market movers since then. So that was a good feeling. And it kind of popped us from a little bit over seven to a little bit below six. And we're just bouncing around in this channel in like the mid to high six range. And so now we need, the trend overall, if you look at like 50-day and 100-day moving averages, as rates are slowly starting to move down, which is great. Now we're waiting on our next round of information. So we got a little bit of a look at that today. We got our first look at Q2, quarter two GDP. it showed the economy growing at 2.8% compared to 1.4% in the first quarter of the year. That was much stronger than what was expected. We're looking at 2% growth, came in at 2.8. And we're talking about the GDP, or gross domestic product, which is all the stuff and services that America produces. Like, that's our product, right? And so that's a big number, for 0.8% to be that much higher. Another figure in that, which is called PCE, that's personal consumption expenditures. That is the Fed's favorite data line. And so over Q2, that number came in a little bit higher than what we planned on. So the market had a hiccup this morning. It's actually recovering nicely as I look at the charts now, because we saw some other economic data declining. So, it's really, you go back to this data dependent market. And so we're just looking at the information that comes out. We have a big inflation reading that comes out tomorrow. It's personal consumption expenditures. So we'll see that's consumer spending habits. So there's a little bit of a preview in the growth in the GDP report. Then we get the real report tomorrow. And then next week we have the Fed meeting. We also have the last, do we have the first Friday of the month? No, it'll be, what's the date tomorrow? The 26th. So yeah, so next week we'll have the unemployment report, or the big BLS number. So just kind of a lot of information we're just looking to see. So these next Fed meeting, PCE, which is inflation, and then employment numbers, really going to be market movers. And that'll say, like, okay, we're going to stay in this trend, or we're going to go up, or we're going to go down. So we'll kind of see what's going to happen with that. So some big economic data coming out over the next couple of weeks. But ideally, the markets are really pricing in that 0.25% rate drop in September. And that's at 100% chance of happening. So we'll see a lot of the pundits out there saying, like, the Fed may have hung on just a little bit too long. We're getting, some really boring economic information showing that jobs numbers were grossly inflated, shocker, from the government's number over the last quarter, which Q4 of 2023. So information's pretty far behind, but grossly overstated a lot of jobs numbers and things like that. So it'll just be kind of interesting to see what unfolds. But right now we're hanging in a little bit of a lowered rate zone. A lot of people that bought in the last 6, 7, 8 months are finding some refinance opportunities to save some money, and then we're just keeping an eye on all that stuff. So things are going okay in the interest rate world, and hopefully we'll see some continued improvement.
Good deal. I appreciate it, Steve. Oh, and one point. So last week when I talked about the 15% appreciation rate year over year, that was Detroit City. I went back and took a second look. So Metro Detroit, we're sitting at 6.7% appreciation rate, which is still really healthy. We are seeing that large growth in the city itself, just because the price of homes are so low in some areas of Detroit. Anything else, Steve?
You know why that's such an important number? So if you look at, let's just say, a $300,000 house, right? And let's look at that as an average. So 6.7% growth on a $300,000 home. That means you're gaining $20,100 a year in that home, right? You get to keep 100% of the value of the house. You get that value of the house, which is your base, for your appreciation for your 6.7%. And the nice part about that is you can buy that house with a $9,000 down payment and, let's say, $9,000 in closing costs, right? So you can take your $18,000 and invest it into a house and earn 6.7% on a $300,000 investment, where the bank is taking $291,000 of the risk. Like, people say, "Oh, I got to make my mortgage payment. How do you factor that?" Well, you got to pay to live anyway. You're going to pay to rent. You're going to pay to do this, like whatever it is. You have to pay to sleep, right? You got to pay to stay. And so, if you think about it, there's really no other investment vehicle. Like, you could put $20,000 in Nvidia stock, and as great as that has been, you're not making $20,000 in a year on that. There's no other investment vehicle like buying a house where you can continue to compound returns on that, especially compound cash on cash returns. Cash out, that's 100% cash on cash return your first year in owning a home. And then the next year, you're getting a 6.7% return on a $320,000 value. So now maybe you're getting $22,000. So year two, now your home is worth $343,000, and all you've had to part ways with is this 20 grand, So it's just, for me, I'm always thinking about, real estate, and they say real estate's like the final frontier to really generate wealth in a really rapid way. And with these markets, even with rates being high and even with inventory being where it is, 4 to 7% is a very, very normal rate of appreciation for a home. And when you look at the cash on cash return, that's how investors look at that. How much money do I have to part ways with? It's pretty amazing.
Yeah, that is pretty
Sorry, I
amazing.
just wanted to
No, I mean,
lay
and
that.
think about that, just to piggyback on that point and go off on a tangent. If you were to invest in the S&P 500, which is like the benchmark that everyone tries to hit, which I think 7% is usually your annual return on those. You had to put, if you're talking about a $300,000 house that you put $19,000, $20,000 down on, and you're getting that return, you'd have to put $300,000 into the S&P 500 to get that type of return, which we know no one would want to put $300,000 on any given day into the S&P 500. It is a crazy way to think about it, and how real estate is a good investment.
Well, and you don't have, I mean, most people, let's face it, most people right now don't have $300,000 that they can go invest in anything.
Right, exactly.
They might have 25 to 30,000, and you can get a 6.5% return on a $300,000 investment with a $20,000 investment. So just something I always try to keep in mind for people, and they're like, oh man, this is expensive or this and that. And it's like, look, I built a house and I had to rent for a year and a half while we did that, which was ill-timed on my part. But I mean, rent is not cheap. We paid just as much in rent as we are on a mortgage, and I didn't get any return on that rental.
Right.
As a matter of fact, I lost my security deposit, not because I damaged it, but because they were too picky. So I lost money on that.
Goodness.
All
All
right.
right. We'll stop it there. We'll see you next week.
All right, man. Take care.